Hello and welcome to this video series where I'm going to be taking you through technical topics frequently tested in the FAR exam. My name is Kritika and I am the founder and senior tutor at the Accountaholics. Are you ready? Let's go!
Hiya and welcome to this video which is all about the revaluation model under IAS 16. Now, the revaluation model is a policy choice and it's got to be applied consistently across a class of assets. What we mean by that is that if you've got, let's say, land and buildings, and you have some property in London and you also have some property in Manchester, you cannot just choose to revalue the property in London and ignore what's happening in Manchester. So to apply it consistently across a class means that those assets with the similar characteristics, they've all got to be revalued if you're choosing to adopt the revaluation model there for that class. There are no fixed rules about how frequently you're going to be revaluing. However, IAS 16 does say that we ought to revalue when the fair value of a revalued asset differs materially from its carrying value. So in other words, when we know that the carrying value of an asset that we are holding under the revaluation model is differing from the fair value. In order to deal with the accounting for a revaluation model, there are essentially 3 steps that we can follow. So let's run through these 3 steps and then apply it to some numerical examples. So step 1 will always be to align the cost of that asset to the market value. Step 2 will be to remove all associated accumulated depreciation. Now, the reason we're doing this is because you hold an asset at its carrying value in the statement of financial position. So if you have populated step 1, and that is to increase the cost to the market value, but you left the depreciation in your financial statements, well then the carrying value of the asset won't really equate to the market value. Therefore, step 2 is essential in ensuring that we are showing the asset at its market value. We'll see this with the numbers as well. So we're going to strip out all the accumulated depreciation. Step 3 is to recognize the revaluation gain or loss. Now, a revaluation gain is a separate reserve entry. So we would set up a revaluation reserve and we would be posting that gain through there. We are going to look at an example when there is a downward reval, so I will address the downward movement when we come on to the numbers. You also need to realise that a revaluation gain is going to be part of other comprehensive income, and therefore it's also going to feature in the statement of changes in equity. We often refer to a revaluation gain as an unrealised gain because you haven't yet sold the asset, yet you're recognising this uplift as an accounting adjustment. So we're going to show it separately as part of other comprehensive income. Another important point to note is that the revaluation reserve cannot be a debit balance. In other words, you can't bring it down below 0. The revaluation reserve is an equity ledger, would typically be a credit entry, and therefore you cannot have it as a negative, and therefore it cannot be a debit balance. So let's actually start to apply these 3 steps to contextualize it a little bit more with some numbers. So the first example here, let's imagine that we've got the cost of an asset that amounts to £1,000. Depreciation that's accumulated equates to 200, and we've got a carrying value therefore that amounts to 800. The fair value is 1,500, and if we choose to use the revaluation model on this asset, the very first thing we're going to be doing is bringing that cost up to its fair value. So here, if we were to increase the cost of 1,000 to the 1,500, you would need to debit cost 500. The next thing we want to do is we want to strip out all of the accumulated depreciation associated with the asset. So we're going to debit accumulated depreciation by 200. Bear in mind, accumulated depreciation is normally a credit entry. So to remove it, we're going to be debiting. The third thing we do is we post that revaluation gain or loss. The way that we calculate this revaluation gain or loss is always by looking at the carrying value and the fair value. It's quite evident here that the fair value is higher than that carrying value, so we are going to have a gain that amounts to 700. This being the difference between the 1,500 fair value and the carrying amount of 800. Let's take this and extend this principle further with another numerical example. Here we have a cost of an asset that amounts to 1,000. The accumulated depreciation is 500, giving us a carrying amount of 500 and a fair value of 800. What's instantly evident is that the fair value is lower than the cost. Now, we've read in our three-step approach that the first thing we always do is to align the cost of the asset to the market value or the fair value or a revalued amount, all of which are interchangeable terminology. So the first thing we're going to do is actually do that, but we need to reduce the cost here. To reduce the cost means we're going to need to post a credit entry. So we're going to credit the cost and thereby reduce it by 200. The next thing is to strip out all of the accumulated depreciation associated with that asset, that being the 500 which we're debiting. Finally, what we do is we derive that revaluation movement. What's evident here is that despite the cost reducing, overall it's a revaluation gain. And that's because to derive that revaluation movement, we always compare the carrying amount to the fair value. And we can see here that the fair value does exceed that carrying value by 300. So we're going to credit the revaluation reserve by 300. Now let's deal with one more example where we might have a situation where we've got a downward revaluation. So here in the numbers, we see that the cost of the asset is 1,000, accumulated depreciation is 800, giving us a carrying amount of 200 and a fair value of 100. Very similar to example 2, we can see that the cost needs to be reduced from 1,000 to its fair value of 100, therefore a credit to cost of 900. We also need to strip out all the accumulated depreciation, so we're going to debit accumulated depreciation by 800. And then in step 3, we notice that the fair value here is lower than the carrying amount. It is a downward revaluation. Now, a couple of important points to mention here. If you have a situation like this, whereby an asset has not been previously revalued upwards, so there is no pre-existing revaluation reserve balance, you must take a downward revaluation as an immediate loss in the P&L. Hence, you see this entry being debited to P&L. Contrast this with if a previous revaluation had existed for this asset and a balance was available, then any subsequent downward revaluation would be absorbed by the balance available in the revaluation reserve for this asset, and then any excess would be taken to the P&L. So it's possible to bring down the revaluation reserve balance to 0 and then take the excess to the P&L. So the situation would be maybe a revaluation reserve balance was £50. We'd be able to debit the revaluation reserve £50 and then £50 we'd also take into the P&L. Let's think about what the subsequent treatment is once you've revalued. And this is something that students often forget. Even though you're revaluing an asset, you must continue to depreciate. Depreciation is an application of the accruals concept, but when we depreciate once an asset has been revalued, it must be a charge that is based on the revalued amount and the remaining useful economic life. So you see that the equation is going to be revalued amount less the residual value divided by the remaining useful economic life. We're going to get a chance to actually practice this in one of the numerical examples coming up. Also, something that IAS 16 mentions as best practice is what we call a reserves transfer. Now, we must realise that when we have a revaluation taking place, typically where we're increasing the value of an asset, the depreciation that is charged subsequently often is higher than what it would have been had that revaluation just not taken place. So what we want to do is we want to work out the excess depreciation that is being charged as a result of this revaluation and transfer that excess balance out from the revaluation reserve and post it through into retained earnings. Why are we doing this? Well, we're doing this to keep our shareholders happy because the higher depreciation charge that results from a revaluation policy is going to impact our profits. It will typically result in lower profits, therefore lower amounts being fed into our retained earnings, out of which we pay dividends. So to keep our shareholders happy, we can simply transfer the excess depreciation out from the revaluation reserve into retained earnings. Again, we'll practice this in the numerical example that follows. So what we have here is a question I've taken from your study materials. It is a requirement where we've got to do two things. In part A, we need to work out the surplus of the revaluation as at 1st of July 20x3. We also need to think about the carrying amount of the freehold land and buildings in the following year at 30th of June 20x4. The information reads that Lakeland has purchased freehold land and buildings on the 1st of July 20W3. Now, if you get slightly confused when you see letters included in dates, just turn them into numbers. So you could say 1st of July 2003. Okay, and therefore in the requirement, 1st of July 20x3 would be 2013. The information also says that 380,000 was the cost, of which 80,000 is attributed to land. The buildings have been depreciated at a rate of 4% on the cost for the 10 years to 30th of June X3. And then on the 1st of July 20X3, so at the beginning of the current year that we're going to be deriving the carrying value for in part B, the property was revalued professionally at 800,000, and of this amount 200,000 is attributed to land. What we also have is information about the remaining life of the asset being 20 years and a residual value of 100,000 for the buildings after the revaluation. So how do we approach this? Now, the best way to attempt this question is to set up a little working whereby land and buildings are separated. I like to do this because it reinforces that land is not depreciated, buildings are. I'm simply extracting the information about the original cost for both the land and buildings. We know that it's going to be depreciated for 10 years up until the point when it was revalued at the beginning of the current year. We only depreciate the buildings, and the depreciation charge is going to be based on that 4% accumulated for 10 years. That gives us 120,000. This means the carrying value at 1st of July 20x3, the beginning of our current year, is going to amount to 80,000 for land, 180,000 for buildings. We then have a revaluation that's taking place on the very first day of the current year. So what I want to do is establish the numbers that they've given in the questions and populate them into this working. So we know the overall valuation is 800,000, of which 200,000 belongs to land. Therefore, the balancing entry of 600,000 must be attributed to buildings. We said earlier that the revaluation gain or loss is always the difference between the carrying value and the fair value. So we can populate that balancing entry as being a gain for the land of 120,000 and for buildings 420,000. Now this question doesn't really ask for double entries, but to just reinforce the three-step process that we covered earlier, first thing we want to do is increase the cost of these assets. If we do it separately, for land, it's going to be increasing the cost from 80,000 to 200,000, giving us 120,000 as the uplift to cost. For buildings, it's going to be the 300,000 cost being increased to the 600,000, giving us 300,000. In step 2, what we want to do is strip out the depreciation that's accumulated. This is the 120,000. And then in step 3, we're going to take that balancing entry to the revaluation reserve. Now here we've already worked out the overall gain. It's simply the summation of the 120,000, the 420,000 for buildings, giving us 540,000 altogether. Remember that revaluation movement is always the difference between the carrying value and the fair value. Now, we have indeed answered the first part of this question, which is what the balance on the surplus would be at 1st of July 20x3. That is 540,000. Now, the second part of this question is getting us to derive the carrying value at the end of the current year, being 30th of June 20x4, which basically means we need to depreciate the buildings. So depreciating the buildings now based on the new estimates they've given us. So the information does tell us that once it's been revalued, it's a 20-year life on the buildings and a residual value of 100,000. So notice in the equation we're taking 600,000 less the 100,000 residual value spread over the remaining life of 20 years. That gives us then the carrying value at the end of the current year that's going to amount to 200,000 for the land and for buildings 575,000. Again, the question doesn't request for you to do this, but just to extend this to a reserves transfer and the accounting for it, if we were to work out what the reserves transfer entry would be, we would simply derive the old depreciation charge that would have been posted on buildings based on the original cost of 300,000, prorated for 4% because that was the per annum charge, giving us 12,000. The new depreciation is now going to be based on the revalued amount, 600,000, less the residual value spread over the remaining life of 20 years, giving us 25,000, and the excess there that we calculate is 13,000. The dual impact taking place would be to debit the revaluation reserve, credit the retained earnings for that 13,000. And there you have it, revaluations explained. I hope you found that useful in helping with your understanding.
I hope you found that video really useful. Until next time, signing out from the Accountaholics.